Everyone wants market returns. Almost nobody wants to pay the price. And the price is not money. It is fear, doubt, volatility, regret, and watching your wealth fall while doing absolutely nothing. Welcome to this explainer. Today we're diving deep into a profoundly uncomfortable truth about building long-term wealth, and we're drawing our insights directly from Morganhousel's phenomenal book, The Psychology of Money. You know, we constantly hear about the math of compounding or the logic of diversification, but today we are talking about psychology. We're talking about endurance and a hidden cost that catches almost everyone completely off guard. When we think about paying a price for something valuable, we usually picture swiping a credit card, right? Or writing a check. But the actual price of investing success is not measured in dollars and cents. It's paid in fear. It's paid in doubt, wild volatility, deep regret, and that uniquely agonizing experience of watching your life savings shrink while having to sit there and do absolutely nothing. It is a massive psychological toll that requires an incredible amount of willpower just to endure. I want you to think of it as the price of admission. Unlike buying a gallon of milk or a new flat-screen TV, the price tag of investing isn't something you can just see on a shelf. It's a hidden currency. It's paid in your ability to stomach a 30% drop in your portfolio without completely panicking. It's paid in those dark hours of the night when you're staring at the ceiling, wondering if your investments are actually putting your family's future at risk. The price is, quite simply, emotional endurance. And this brings us right to a central theme of Chapter 15, Nothing is Free. Literally everything has a price. The secret to success with money is just figuring out what that price actually is and then, honestly, deciding if you're willing to pay it. But the fundamental problem with investing, the price is completely invisible. You don't get the bill up front. You only experience it firsthand, usually when the market is in free fall and it feels like the bill is already severely overdue. Think about ordinary, everyday goods. When you want a new car, you look at the sticker on the window. Okay, $30,000. A new house might be $500,000. A nice family vacation, maybe $5,000. You know exactly what you are giving up to get that item. It's clear as day. But what is the price of investing returns? There is no sticker. And because that price tag isn't visible, when the market drops, it doesn't feel like you're just paying the natural cost of a good. It feels like something is terribly, fundamentally broken. So let's pause and really consider this for a second. What is the actual price of an S&P 500 return? In the 50 years ending in 2018, the S&P 500 increased 119-fold. That is a staggering, life-changing amount of wealth. All you had to do was sit back and let your money compound. Sounds totally effortless, right? But here is the massive catch. Just hold stocks for the long run sounds incredibly easy until you are the one sitting in the trenches, watching your life savings collapse during a recession. You know, there's a great saying that every job looks easy when you aren't the one actually doing it. When we look at a historical chart, massive market drops just look like tiny, harmless little blips on this inevitable upward climb. But actually living through those blips in real time, that requires enduring immense emotional pain. To put this into perspective, let's look at a massive number, 35,000%. This is the astonishing return of Netflix stock from 2002 to 2018. If you held Netflix during this specific period, you captured one of the ultimate investing prizes of the modern era. You basically found the golden ticket. But let's look at the emotional cost of holding that golden ticket, 94%. During that historic 16-year run, Netflix traded below its previous all-time high on 94% of days. Really think about the psychology of that for a second. For 94 out of every 100 days, you woke up, looked at your portfolio, and realized you had less money than you did at a previous peak. You literally spent nearly 2 decades feeling like a loser just to eventually capture that 35,000% gain. Let's look at an even more extreme example, Monster Beverage. Between 1995 and 2018, it delivered an astronomical 319,000% return. That is among the highest returns in recorded history. That is the kind of wealth generation that permanently changes family trees. Yet to earn that phenomenal wealth, investors had to endure seeing their portfolio below its peak 95% of the time. Are you seeing the pattern here? The larger the return, the higher the invisible price. You are literally paying for that wealth with months, even years of regret, second-guessing, and this gnawing uncertainty in the pit of your stomach. So the absolutely crucial point here is how we frame this emotional pain in our own minds. It all comes down to understanding the critical difference between a fee and a fine. A fine is a punishment for doing something wrong, right? Like a speeding ticket. When you get a fine, your natural psychological response is to change your behavior so it never ever happens again. But a fee is completely different. A fee is the cost of admission for something worthwhile. You gladly pay a fee. The problem is, most investors treat market volatility like a fine. They see their portfolio drop 20%, they feel punished, and they try to maneuver to never let it happen again. But volatility isn't a fine, it's a fee. Let's use a quick metaphor to make this super concrete. Imagine you want a brand new $30,000 car. You've basically got three options. Option 1, you pay the price, which in investing means accepting the volatility. Option 2, you buy a cheaper, used car. In investing, this means choosing a lower risk, lower return asset, like cash or bonds. You pay a lower emotional price, but you get a lower reward. Simple. But so many investors try option 3. They try to steal the car. They want to drive off the lot with the high returns without paying a single cent of the volatility price tag. And how do they try to steal it? Through market timing. Jumping in and out, desperately trying to dodge the drops and only catch the rebounds. But let me tell you, the money gods tend to brutally punish those who try to get returns for free. Look at this fascinating data from Morningstar. They analyzed 112 tactical mutual funds. These are funds entirely designed to jump between stocks and bonds to magically avoid volatility during the wild market swings of 2011. This was supposed to be their moment to shine, yet 103 of them failed to be a simple, hands-off index fund. Only 9 outperformed. The escape routes simply do not work. And this leads to a truly tragic irony in the psychology of money. By trying to avoid the price, investors almost always end up paying double. When you jump out of the market to avoid the pain of a drop, you often just lock in your losses. Then, because you're sitting on the sidelines chasing certainty, you completely miss the eventual recovery. So you pay the agonizing emotional price of the crash, but you strip yourself of the financial reward of the rebound. It's a lose-lose. And listen, this isn't just an individual investor problem. It happens at the absolute highest levels of corporate finance too. Take General Electric under former CEO Jack Welch. Welch was famous for ensuring GE's earnings were perfectly smooth, quarter after quarter. If there was a negative surprise, as Welch himself later admitted, his managers would scramble to quote-unquote find tens of millions of dollars to massage the numbers and offset the gap. They essentially manufactured the illusion of a perfectly smooth ride for their shareholders. But that smoothness, it was a total illusion. When companies or investors try too hard to artificially erase uncertainty and avoid the daily price of reality, you don't actually eliminate the risk. You just defer it. You let it build up in the background into a massive hidden bill. GE shielded its investors from volatility for years, but eventually the bill came due, resulting in catastrophic, dynastic losses that wiped out immense shareholder value. The exact same thing happened to Fannie Mae in the early 2000s when they underreported earnings to create this fake illusion of predictability. Ultimately, you cannot cheat the price of admission. Let's bring this all back down to earth with a concept we can all easily grasp: $100. That is roughly the cost of a basic ticket to Disneyland. And last year alone, over 18 million people happily pulled out their wallets and paid that price. Now, when you hand over that $100 at the gate, you don't feel angry. You don't feel like you've been slapped with a traffic ticket or punished for doing something wrong. Why? Because you know exactly what you are paying for. An incredible experience. You willingly exchange your cash for the magic. Well, volatility is the exact same ticket for market returns. Sometimes it rains at Disneyland, and sometimes the market crashes. But if you view that admission fee as a fine, you will spend your entire investing life miserable, and you will never ever enjoy the magic of long-term compounding. As we look at this core principle from the book, everything has a price, but not all prices appear on labels. The real takeaway here isn't that you must blindly hold on to investments forever. And it certainly isn't to minimize how deeply terrifying a market crash can be in the moment. The goal here is honesty. It's about looking at the invisible price tag of wealth, the fear, the doubt, the endless days spent below previous highs, and recognizing it as a legitimate, required transaction fee. So, I want to leave you with this final, vital thought. The goal of investing is not to magically avoid every painful moment. The goal is to know the price before entering. If you honestly cannot stomach the volatility fee, there is absolutely no shame in choosing a lower risk path and buying the used car. But if you want the ultimate reward, before you ask what return you want, ask what price you are actually willing to pay. Thank you so much for joining us on this explainer.